Welcome to NorthFlow Finance. Canadian REITs have had a rough few years. If you followed the sector through 2022 and 2023, you watched unit prices fall, distribution growth stall, and the headlines fill with warnings about rising debt costs and weakening property valuations. The natural question for any investor today is simple: has anything actually changed, and is there real value here now? The answer, with some important caveats, is yes, but only if you know what to look for. In this video, we are going to break down exactly what happened to Canadian REITs, what has shifted in 2026, the single most important metric for evaluating any REIT, and the three names that stand out as genuine opportunities right now. We will also cover what to avoid, because there are still plenty of landmines in this sector. Let us get into it. To understand where Canadian REITs stand today, you have to understand what damaged them in the first place. REITs are structurally different from regular corporations. By law, they must distribute the vast majority of their taxable income to unitholders as distributions, which means they cannot retain large amounts of cash to fund growth. Instead, they rely on debt and equity markets to finance acquisitions and development. When interest rates are low, this model works beautifully. Cheap debt amplifies returns and makes the relatively high yields that REITs offer look attractive compared to bonds. But when rates rise sharply, the model gets squeezed from both ends, and that is exactly what happened. The Bank of Canada raised its overnight rate aggressively, eventually reaching 5%. This hit REITs with a double blow. First, refinancing costs surged, eating directly into the distributable cash flow that funds unitholder distributions. Second, as bond yields climbed, the income advantage that REITs had long enjoyed over fixed income evaporated, making their units less attractive to income investors and pushing unit prices down. Some REITs froze their distributions. A few cut them outright. The sector as a whole dramatically underperformed the TSX 60 and the S&P 500, even on a total return basis including reinvested distributions. It was, by any measure, a painful period to be a REIT investor. But pain and permanent impairment are two very different things, and that distinction is what creates opportunity. The most damaged segment was office REITs. The combination of rising rates and the permanent shift to hybrid work arrangements created a genuinely toxic environment for office landlords. Vacancy rates climbed, lease renewals were signed at lower rates, and distributions were cut. Allied Properties is the clearest example. Even after a significant distribution reduction, its payout coverage ratio remained uncomfortably tight heading into 2026. And here is the critical thing to understand: the shift to hybrid work is not a temporary disruption that will reverse once the economy improves. It is the new baseline. Office demand has been structurally re-rated lower, and any recovery in the sector will be slow, uneven, and uncertain. The lesson here is an important one: not all REITs are equal, and the sector label alone tells you very little about the quality of the underlying business. So if that is the problem, what has changed? The rate environment that punished REITs has now meaningfully reversed. The Bank of Canada cut rates 275 basis points between mid-2024 and late 2025, bringing the overnight rate back down to 2.25%. That is a dramatic reversal. Lower financing costs directly improve REIT cash flows as debt is refinanced at better rates, and the income advantage over bonds is once again widening. This matters enormously for valuations. Many Canadian REITs still trade well below their net asset value, the estimated fair market value of their underlying properties, because unit prices never fully recovered from the rate-driven sell-off. That gap between market price and net asset value is the opportunity. If rates stay low and property values stabilize, the market will eventually close that discount, delivering capital appreciation on top of the ongoing distributions. To put those numbers in perspective, the Bank of Canada cut rates by 275 basis points in a little over a year. That is an enormous reversal. For REITs with variable rate debt coming up for refinancing, every 100 basis point cut translates directly into higher distributable cash flow. And with the overnight rate back at 2.25%, the bond yield competition that was suppressing REIT valuations has largely abated. Income investors are once again looking at REIT yields and finding them genuinely attractive relative to government bonds. This is the macro tailwind that makes 2026 a more interesting entry point than 2023, but the rate recovery alone is not a reason to buy any REIT indiscriminately. The quality of the business, the sustainability of the distribution, and the strength of the balance sheet still matter enormously. And that brings us to the most important part of this video, the single metric that most investors overlook when evaluating REITs. Most investors look at dividend yield when evaluating income stocks. A higher yield looks more attractive. But for REITs, yield alone is dangerously misleading. A REIT yielding 9% might be heading for a distribution cut, while a REIT yielding 4.5% might be the safer, better long-term buy. The metric that actually reveals distribution safety is the FFO payout ratio, specifically, what percentage of funds from operations is being paid out as distributions. FFO stands for funds from operations. It is the standard measure of REIT earnings, specifically designed to strip out non-cash depreciation charges that would otherwise distort net income figures and make REIT distributions look unsustainable when they are actually perfectly fine. Think of the payout ratio this way: if a REIT earns $1 per unit in FFO and pays 60 cents in distributions, the payout ratio is 60%. That leaves 40 cents as a buffer, enough to absorb a bad quarter, a tenant departure, or a refinancing cost increase without touching the distribution. If the same REIT is paying out 95 cents, that 5-cent buffer is razor thin, and any operational hiccup becomes a distribution cut. The healthy range for Canadian REITs is generally considered to be between 55 and 80%. Below 55, the REIT may be over-retaining cash unnecessarily. Above 80%, the distribution starts to look fragile. Above 90%, the warning lights should be flashing. This is the lens through which the best Canadian REITs in 2026 stand out, so keep this metric in mind as we walk through the names. With the macro backdrop and the key metric established, let us look at the 3 Canadian REITs that stand out as genuine opportunities in 2026. These are not the cheapest names on the TSX. Cheap and good are not the same thing. These are REITs with strong fundamentals, sustainable distributions, and a combination of income plus potential capital appreciation that makes them worth owning for the patient investor. We will look at each one in detail. CAPREIT, Canadian Apartment Properties REIT, is the clearest example of a high-quality residential REIT trading at what looks like an irrational discount. Canada's rental housing market remains structurally undersupplied. Population growth through immigration, combined with a chronic shortage of new purpose-built rental housing, means demand for CAPREIT's apartments is not going away anytime soon. The occupancy rate of 97.6% reflects that reality. There is essentially no vacancy. The FFO payout ratio is approximately 61%, comfortably inside the safe zone, and the distribution has grown at an annualized rate of 5.4% over the past 5 years. But the most striking data point is the NAV discount. The Trust's net asset value per unit is estimated at around $54.79, but the market price implies investors are acquiring those apartment buildings at nearly 39% below their appraised value. Management has responded by aggressively repurchasing units in the open market, which is one of the strongest signals a management team can send about their confidence in the underlying value of the business. When insiders are buying back units at a 39% discount to NAV, that tells you something important about where they think fair value is. Granite REIT is the industrial and logistics REIT that has quietly built one of the most impressive dividend growth records in the entire Canadian market. In 2026, Granite raised its distribution for the 15th consecutive year, this time by 4%, cementing its status as a true dividend aristocrat. That kind of consistency does not happen by accident. It requires a business model that generates predictably growing cash flows year after year. The numbers back it up: an FFO payout ratio of approximately 67%, same property net operating income growth of 6.3% in the most recent fiscal year, and a portfolio spanning over 62 million square feet of logistics and warehouse space across Canada, the United States, and Europe. Industrial real estate benefits from the long-term structural tailwinds of e-commerce growth and supply chain localization, demand drivers that are unlikely to reverse. Every parcel that gets shipped needs to be stored and sorted somewhere, and those somewheres are Granite's properties. Granite is not the cheapest REIT on the TSX, but it earns its premium through consistent execution and a balance sheet that carries one of the lowest debt-to-gross book value ratios in the sector. When you are paying up for quality, Granite is exactly what quality looks like. Choice Properties REIT deserves mention for investors who prioritize stability above all else. Its anchor tenant is Loblaw Companies, Canada's largest grocer, which means its rental income is backed by one of the most recession-resistant businesses in the country. People have to buy groceries. It does not matter what the economy is doing, whether markets are up or down, whether consumers are feeling confident or nervous. Grocery spending is one of the most stable categories in consumer expenditure, and that stability flows directly through to Choice Properties rental income. The AFFO payout ratio is approximately 75%, which sits comfortably inside the healthy zone. The distribution has grown for 10 consecutive years, earning it aristocrat status alongside Granite. And the grocery-anchored retail format that Choice focuses on is one of the very few segments of physical retail that has proven genuinely resilient against e-commerce disruption. You can order a sweater online. You can order electronics online. But most Canadians still walk into a grocery store multiple times a week. Choice Properties is the REIT for investors who want reliable, growing income without having to worry about existential threats to the underlying tenant base. If you put these three side by side, you can see why they stand out from the broader REIT sector. CAPREIT has the lowest FFO payout ratio at around 61% and the most dramatic NAV discount, making it the most compelling pure value play. Granite sits at 67% with 15 consecutive years of distribution growth, the best combination of income growth and balance sheet discipline in the industrial space. Choice Properties at 75% is the most conservative of the three, but conservatism backed by Canada's largest grocer as your anchor tenant is a feature, not a bug, particularly for income investors who cannot afford distribution cuts. The contrast with what to avoid is just as instructive. Office REITs and high-yield traps often have payout ratios above 85 or even 90%, leaving almost no margin for error. A single bad quarter can turn a 90% payout ratio into a distribution cut, and distribution cuts in REITs are brutal for unit prices. Let us spend a moment on what to avoid, because avoiding landmines is at least as important as finding winners. The categories worth steering clear of remain office REITs and any REIT with an AFFO payout ratio consistently above 85%. Office fundamentals have not recovered, and as we discussed earlier, the structural shift to hybrid work is not a temporary disruption, it is the new baseline. High vacancy rates, lower renewal rents, and rising operating costs are likely to be a feature of the office market for years to come. High payout ratios leave no margin for error. When a REIT is paying out 90 cents of every dollar it earns, it is one bad quarter away from a distribution cut that will crater its unit price. The other red flag is excessive debt. REITs are inherently leveraged businesses, that is part of the model, but there is a meaningful difference between disciplined leverage and reckless leverage. In a higher-for-longer rate environment, REITs with net debt to EBITDA above 10 times are carrying real refinancing risk that can overwhelm an otherwise healthy operating business. Be skeptical of yields that look too good to be true. In REITs, as in most areas of investing, if the yield is dramatically higher than peers, the market is usually pricing in a distribution cut that has not yet happened. Let us bring this all together into a practical framework. When you are evaluating any Canadian REIT, run it through these four filters. First, FFO payout ratio, target between 55 and 80%. This is your primary screen for distribution safety. If a REIT fails this test, everything else is secondary. Second, NAV discount, buying below net asset value gives you a built-in margin of safety and capital appreciation potential as the market closes the gap. Third, debt load, net debt to EBITDA under 8 times is comfortable, above 10 times starts to introduce real risk. And fourth, tenant quality, grocery-anchored, industrial logistics, and residential tenants have demonstrated resilience through the rate cycle in a way that office tenants simply have not. Apply these four filters consistently and you will avoid most of the landmines in the Canadian REIT sector. CAPREIT, Granite, and Choice Properties all pass every one of these screens. That is not a coincidence. It is the result of management teams that prioritize balance sheet discipline, distribution sustainability, and operational excellence over short-term yield maximization. Canadian REITs are not a set-it-and-forget-it investment. The sector contains genuine value alongside genuine landmines, and the difference between the two often comes down to a handful of financial metrics rather than anything complicated. Focus on the FFO payout ratio, the NAV discount, the debt load, and the quality of the tenant base. Avoid office. Be skeptical of yields that look too good to be true. The rate environment has turned more favorable. The Bank of Canada's rate cuts have directly improved cash flows for well-managed REITs, and the income advantage over bonds is widening again. Many of the best operators in the sector are still trading below their fair value. For patient, income-focused investors willing to do the work, Canadian REITs in 2026 offer something that has been rare for the past 4 years, a genuine margin of safety paired with a growing income stream. That combination is worth paying attention to. CAPREIT for value and residential exposure. Granite for industrial growth and 15 years of dividend increases. Choice Properties for stability and recession-proof income. Those are the 3 names we would be watching in 2026. That is it for today's video. If you found this analysis useful, please hit the like button. It genuinely helps this channel reach more investors. Subscribe so you do not miss our next deep dive into Canadian markets. And drop a comment below, which of these 3 REITs interests you the most, CAPREIT, Granite, or Choice Properties? Or is there a Canadian REIT we did not cover that you think deserves attention? We read every comment and it helps us decide what to cover next. Thanks for watching NorthFlow Finance, and we will see you in the next one.